Welcome as we take a look at some of the charts for us traders and work out where the markets are going to go next. It's currently the 8th of November, and we've just come off the back of what's been one of the best weeks in equity markets seen this year. There's been a little bit of money taken off the table in the first couple of days of this week. It's just a small retracement at the moment, but where in the longer term should we be expecting the markets to go? Let's catch up now with our guest this morning. It's Serge Berger from thesteadytrader.com. Serge, welcome. How do you feel about the markets at the moment? As I said last week, it was an absolutely stunning week. What's been driving things, and what do you think is going to be pivotal for the next few days?
Yeah, thanks, Jeremy. So I think last time we were on a number of weeks ago, we talked about the potential for equities to face some seasonal headwinds, and that indeed happened. We then got very oversold about a week and a half ago or thereabouts, where we were covering our shorts and instructed clients that, we're letting them know that we're doing that. We're now back at a point where we were about a month and a half ago-ish when we last spoke, is where I think we're once again overbought. So this remains very much a somewhat technically driven market. So what I brought along is a couple of charts. The first one, it's just, I think, the major context that sometimes gets lost when people just navel gaze at simple charts. And what this is just showing us is the inverse relationships of bond yields. We're looking at the 10-year Treasury yield, which is in orange, going lower, and the risk assets represented by the NASDAQ 100. It's really just a few stocks here that have gone higher in blue. And so essentially we're seeing a direct function of lower rates leading to risk assets rallying. What we're going to face today, however, is not only and for the rest of the week, is more Fed speakers. We have Chair Powell speaking typically after the Fed meeting, which was last week. We get a lot of Fed speakers the following week, which means this week. But also we're going to get a pretty big 10-year Treasury auction at 1 p.m. New York time. That is 6 p.m. UK time. And so that will be a real test. I would expect that overhead supply to potentially drag on the market and potentially bring Treasury yield on the 10-year tenor maybe a bit higher, which, if this correlation stands, would probably bring stocks back down. So it's really just a back and forth.
Yeah, we've got the US dollar rising for a third day as we speak today as well. It's only, again, a small retracement on some of the activity we saw last week. Where are we in terms of this equity move then? And if we do see yields rise again, what are you expecting? I mean, we're in this seasonality, as you said last time. But is there any sort of indication technically as to where you see things moving over the next few weeks and back into the back end of the year?
Yeah, so I think this is really the main question that we're seeing. A lot of people ask themselves: is seasonality this year going to play the typical bullish sort of role that we tend to see in the end of the year? Well, first of all, I think understanding, what seasonality really is made up of towards the end of the year is important. It's typically a function of a lack, an absence of sellers, because in the U.S. particularly, you do have people who tend to wait to sell their winners for tax purposes until January the following year. However, this year there's a lot of losses one can offset versus gains, so that typical lack of sellers may not happen. The other thing is you have what's called, I call it fund manager sort of underperformance or performance anxiety, where they kind of buy up, the leading stocks or whatever their asset is. In this case, it's the equity market, to not look so bad come January in the quarterly statements. The question, of course, is what are the headwinds from a macro perspective? I would argue this year we have more headwinds from a macro perspective, as higher rates are starting to finally to bite. And I think the typical seasonality is going to be more of a fits and starts kind of move, very much like what we saw over the past week and a half. So expecting the S&P to get back to 4,600 is probably more difficult to see this year than in other years. I still think we have to give it some chance, but I would prefer to be a seller on rallies and a buyer on dips, very much kind of like the playbook has been for the past couple of months or so. So if we see downside in the S&P, I could easily see us get back to where we were, week and a half ago, just north of 4,000. On the upside, again, we'd probably need to see some really good news to get us back to 4,500. But I prefer to be a seller here than a buyer, all else being equal.
What about European markets? Thinking mainly DAX, which is a nice volatile market for us traders to use. That looks a little bit frail at these levels.
It does look frail, and I brought along a chart here that I know you and I have looked at the past few times we were chatting, and you look at the German economy, and it's just not really good. At the end of the day, the correlation to risk assets is very similar here. If you look at U.S. equities and German equities, of course, it's not the same, but they are closely correlated in terms of flow. So again, lower yields stateside and in Germany to some extent has led to that pop in the DAX. So here too, I would expect if we see some sort of magical unicorn rally where the flows overpower the macroeconomic realities, I don't see why we can't see 15,400 in the DAX. Absence of that, I think we're right back to where we were again in a week and a half ago, somewhere near the mid 14,000s or so. So again, the reward to risk probably favoring on the downside through the next couple of few weeks or so. But again, I would use that opportunity. I would look at this more as a trading market rather than something where we want to be structurally short or structurally long for that matter.
It's interesting talking about the economic backdrop to the German economy. The global economy looks like we have got some headwinds for growth. This seems to be playing out in oil. What are your thoughts on the oil markets, bearing in mind this most recent drop that we saw yesterday? I was reporting this morning, yesterday's declines were really quite vicious. Concerns clearly about lack of demand. But on the other side, we've got this geopolitical concern or worry to concern ourselves with.
Yeah, absolutely. I think the geopolitical situation is probably the bit in the background that kind of puts a floor underneath oil. I don't think we're back in a situation where oil has is at the threat of sort of a new major bear market or anything. I mean, obviously, I'm looking at Brent crude here through the lens of the CFD contract. We've been basically lower since March of 22, so about a year and a half ago. But we are finding some simple technical support here at some moving averages, and we're finding what used to be resistance may become support. So I don't think there's a heck of a lot of downside here. I'm not a buyer right now of oil and energy stocks right now, just because I think the broader risk-off environment is still potentially there. But at some point, even from a heating season perspective here in the Northern Hemisphere, you probably will see some sort of a bid come back in. To me, it's kind of a no touch. I do not want to be short oil, but I also don't really want to buy it just yet. Is kind of my positioning at this point. We got rid of all of our energy longs over the past up until about a week ago, the prior 2 weeks or so. So into sort of mid-October, just because we didn't really see the reward to risk on the long side. But we're looking to buy them again.
Yeah, talking about this opportunity to look at new levels in which to enter a market. How about gold? We saw this really quite strong rally, relatively speaking, from the beginning of October right the way through the month. There's been a bit of an opportunity here to take it lower, but I guess it's just a question of finding a better price to go long. Is that the right way to trade this?
I view it that way. Whether that's the right way or not is, of course, another question. But yes, I mean, that's how we're looking at it. I think it's always worth reminding ourselves in what environments does gold tend to thrive. And it's typically when you see real interest rates go somewhat lower. I think we're at a point where we've kind of peaked on real rates. Probably real rates in the United States are about 2%. If you look at the 10-year yield, subtract CPI. And I would expect that to go lower, certainly not much higher from here, or at least that's our base case. So, yes, I'm continuing to use the opportunity here with oil kind of pulling back a little bit to add to positions. We yesterday did some bull put spreads on it, which is an option strategy that allows us to not have to be directionally immediately correct. Yeah, I like it structurally here. I really do. I think, you have the potential of unfortunately and sadly, it's sort of the war premium in gold as well. But yeah, I think here, the next upside target I'm looking at is just north of 2,000. So that 2,100 level is probably the next sort of real major hurdle. That's an obvious level, maybe too obvious. On the downside, we have a lot of support just north of 1,800, so 1,820 or so. You've got a lot of technical support coming in, where I would argue that's probably about the downside that we could potentially see.
Okay, Serge, look, we'll leave it there, but thanks indeed for joining us. Let's look at what's happening in the markets as we consider the geopolitics around the economic backdrop. That's Serge Berger from thesteadytrader.com.